and welcome to the second ever episode of Enjoy Investing. Now, I thought for this episode, I'm just going to talk about how I like to invest and my own style of doing things. So, starting off with me, age comes into this. So, for example, with older people, there's less of a risk tolerance and it's more of a preservation of capital, whereas I'm only 22 years of age. Therefore, I take a more riskier strategy. So I have less of my cash invested in bonds, less invested in gold, and I'm more heavily weighted in stocks. And I also invest in startups as well. So what I'll do is I'll show you the different brokers and the different platforms that I use. Now, I don't know if there's any copyright here or anything, so I and I'm not sponsored by any of these either. So, but I'll just show you what I use here. So, the first one I use is Trading 212, and with Trading 212 is I use this one for obviously trading, but I mainly invest in ETFs, growth stocks, and value stocks. And with the trading side, I will do some swing trading if I think the trends look correct. And so yeah, and also with Trading 212 there is a app that links to this called ProQuant. So let's see if I'll put the images on so you can get more of a visualization of what the platforms are. So essentially what ProQuant does is when markets are quite quiet and nothing really interesting is happening, I'll put more of my capital into the trading side of my Trading 212, because usually with my Trading 212 is I have most of my money invested in my ISA because it's tax free. With Trading 212 you have an ISA option as well as with lots of other brokers. But when markets are quite calm, I will follow some algorithms. So it's like a trading robot. Let's see if I can get a full picture up of this. So here you can see on this one here, someone's following this strategy, Forex strategy, and you can see their returns there. So that's what I'll do when markets are calm. But when markets start to get volatile, because a lot of the time with algorithms is when the market conditions change or when the market conditions are strange, the algorithms don't always work efficiently. So I would like click that and stop following the algorithm. So yeah, that's that with the Trading 212. I'll also show what I'm invested in as well in my Trading 212. I'm invested in lots of different things, but I'll go through the Trading 212 because I think to go through all of them would take a lot of time. Now, coming back to my ETF investing, I'll run through there's this theory called the efficient market hypothesis. Probably spelled that really wrong, but it'll correct. There we go, the efficient market hypothesis. So there's different forms of the efficient market hypothesis. There's strong form, there's medium form, and there's weak form. So let's see if I can. Basically, with the efficient market hypothesis, there we go, here's the different definitions and forms. So the weak form suggests that all past information is priced into the securities. Fundamental analysis of securities can provide an investor with information to produce returns above market averages in the short term, but there are no patterns that exist. Therefore, fundamental analysis does not provide long-term advantage, and technical analysis will not work. The semi-strong efficient market hypothesis implies that neither fundamental analysis nor technical analysis can provide an advantage for an investor, and that new information is instantly priced into securities. And then the strong form efficient market hypothesis, which says that all information, both public and private, so like insider trading, is priced into stocks and that no investor can gain an advantage over the market as a whole. Strong form efficient market hypothesis does not say some investors or money managers are incapable of capturing abnormally high returns, because that there are always outliers included in the averages. Like for example, that means like the whole the monkey throwing darts theory, which is where some people believe that a monkey could throw darts at a dartboard with different stocks on and could outperform many fund managers. Now, with me, I don't really buy the efficient market hypothesis, because you have people like Warren Buffett, who's a value investor, who he does fundamental investing. Is that the word for it? I think it's value investing. Anyway, lots of people from the Benjamin Graham school of thought have consistently outperformed the market. And I also don't think the markets always converge instantly on new information. But I do think that when it comes to trading, the quicker you can get access to information, you have an edge. So like people who use a Bloomberg terminal, that's I'll show you the Bloomberg terminal as well. This is, you get real time information from this. So obviously, if you are trading, I do think you can get an edge if you're first to the information, definitely. Because I think when it comes to trading, you need to act before the market's acted. My philosophy is if it's already on the news, then it's already too late. That's my theory anyway. You've got to try and find something and jump on something before it's on the news. It's kind of like 4D chess in a way. Okay, so moving on from that, I also use Hargreaves Lansdowne. So here you can invest in like managed funds. So for example, I have like funds managed which invest heavily in AI and like things that are on the cutting edge, like green technology, high technology, financial technology, and you can invest in lots of different funds, and these are managed funds with Hargreaves Lansdowne, and they give all of the information of these funds on there. Let's see if I can get an image of, because I don't want to be logging into everything. Here we go. Don't want to be logging into everything and wasting more time. So that's what it looks like on the Hargreaves Lansdowne, and it gets all of your information, and you can invest on here. I think Hargreaves Lansdowne is quite good as well. Then what else is there? So then you have things like Crowdcube. So this is if you want to invest in startups. You can invest in them here. Let's see if there's any images showing what the web page looks like. Well, you can go on there and check it out anyway. It will look similar to this other one, which I'm going to show you as well, which is it's called Seeders. So this, you can also invest in startups. This is if you want to take a more long-term approach, if you may be a young investor, if you're passionate in investing in startups. But with startups is that there's some of these offer a secondary market where you can actually trade, but a lot of the time it's locked up in the investment, so it's not a very liquid investment, and also your investment value can get watered down as through the different funding rounds. So there'll be different funding rounds of a startup. So like funding rounds. So yeah, you have like Series A, Series B, Series C, and each time it gets watered down, but you're hoping that the company does well and the share price then goes up. And then for like the more, I don't know whether you want to call this savvy or gambler type of people, you have Smarkets. Markets. and you also have, so this is like you can bet and trade on things like politics, like outcomes of elections, on like interest rate changes, and there's also the Betfair betting exchange. That this is, and you can actually trade. You can actually trade on these, and people have professional careers trading on betting exchanges. So this is what a betting exchange would look like. Um, so I'm trying to think if I've covered everything here. Um, yeah, so I think I've covered everything there. Also, when it comes to investing, is there's so you want to rebalance your portfolios regularly as well. So, like for example, in a boom period, how do I close this now? Like in a boom period, in a recessionary period, as Warren Buffett said, you want to be fearful when others are greedy and greedy when others are fearful. So when it's in a recession, you want to, in my opinion, what I would do anyway, is invest more heavily in stocks. And even if it does go down further, you still get a dividend. And then obviously, as the economy does really, really well, you want to start investing more into gold because the market does have cycles and it will crash at some point. And when it crashes and everyone loses the value of the stocks, you want to be in some form of safe assets. And let me think. So yeah, and yeah, so the Ray Dalio all weather portfolio. So then there's this as well. This is one of Ray Dalio's theories. So this is how he thinks over the long term. So if you have 40% in long-term bonds, 30% in stocks, 7.5% in commodities, 7.5% in gold, and 15% in intermediate-term bonds, that would have given you the best and most stable returns over the long-term period. However, it has been criticised for the weighting of bonds because bonds did unusually well over the past century. Um, but so, say for example, if you're a younger person, you should be more heavily weighted in stocks because you have time to ride out the volatility. And then, like when you're older, obviously you want to be more invested in bonds and gold, and commodities are just there to diversify. And if you do want to diversify, you can actually invest in like art funds, like alternative investments. So you can actually invest in art, but obviously you don't get a dividend from these. And they have actually outperformed the market. There's all kinds of things you can invest in to diversify, like vintage cars, fine wine, lots of different things like this. So, so yeah, and so in terms of the way I would invest, I would take what's called a. Let me just see how long this has been recording for. 30 minutes. Okay, I won't. I'll try and keep it under 50 minutes. So, oh, what was I going to say now? I'm going to have to pause it because I forgot what I was going to say. Okay, I've just remembered now. So I was going to say the strategy I would use is what's called a mixed strategy. So this comes into game theory. So I would basically use fundamental and technical analysis. I wouldn't rely on one and rule the other one out. I think both should be used. So like knowing the fundamentals of a company, and also looking at its trends and its past data and bringing that all in together. And so that's the strategy I would use. I take more of a medium to long term strategy. I understand with like hedge funds they have to take more of a short term strategy to because they have to cater for the needs of their clients. But I think if you're just a private investor, take a more long term strategy. And so yeah, that's what I would say. And don't take excessive risks. Understand that um, the way I see the stock market is it's a way of transferring money away from the impatient towards the patient. So that's my investment philosophy. And so that's kind of like my little strategy there. I like to be nice and diversified, although if I do see if I do like see something that I think is going to be really well, I will put a lot of money in and make a high commitment investment there. But usually I like to keep things nice and balanced. I like to invest in stocks as well, more than anything. So I'll wrap that up there before it gets to 15 minutes, and I hope this has been helpful to you. And I'll see you in the next episode. Thank you.